Something inside the Federal Reserve has just been exposed. And the silence surrounding it is more deafening than anything your financial news anchor read to you this morning. Not the silence of a slow policy week. Not the silence of a committee taking a breath between rate decisions. The silence of a deliberate institutional suppression mechanism that has been operating in plain sight for decades, and which a leaked set of internal Fed minutes has now placed directly under the spotlight. I am OG Peter. This is SilverDispatch. And what I am about to walk you through is not a conspiracy theory dressed up in financial language. It is a forensic reconstruction of a documented suppression architecture, one built not to protect you, but to protect the system that depends on you never fully understanding what silver actually represents. Stay with me, because what follows will permanently change how you read a silver price quote. Let us begin where all serious analysis must begin. Not with the leak itself, but with the system the leak reveals. The Federal Reserve does not simply set interest rates. It manages narratives. And the most important narrative the Fed has managed since the collapse of Bretton Woods in 1971 is this: that the US dollar is the only monetary anchor worth holding. Silver, historically the people's money, the merchant's standard, the working class store of value across 5,000 years of human commerce, represents a direct and daily referendum on that narrative. Every time silver rises, the dollar's credibility quietly bleeds. Every time silver's price is held down, the illusion of dollar supremacy is reinforced. This is not speculation. This is the operational logic that the leaked minutes now confirm in language that is remarkably direct for an institution that usually speaks only in carefully engineered ambiguity. Here is the architecture you need to understand before we get to the leak itself. The global silver market operates across three distinct layers. The mining and refining layer, where physical metal enters the supply chain. The commercial and industrial layer, where that metal is consumed by solar manufacturers, semiconductor producers, defense contractors, and medical device companies. And the financial layer, the paper market, where futures contracts, options, lease arrangements, and derivative instruments create a synthetic representation of silver that can be expanded essentially without limit, regardless of what the physical layer is actually doing. That third layer, the paper layer, is where suppression lives. It is where price is manufactured rather than discovered. And it is the layer that the Fed's internal communications, now partially surfaced, describe with a clinical precision that should alarm every person watching silver prices and wondering why the number on their screen refuses to reflect the physical reality underneath it. The gap between those two realities is where this story begins. On March 14, 2026, a document circulated among a small network of institutional commodity analysts. Its origin was described as internal Fed working group communications from late 2025, specifically a subcommittee tasked with monitoring what the document itself called monetary metal stability risk. The language inside that document is worth sitting with carefully, because it does not read like the sanitized public communications the Federal Reserve releases to the press. It reads like a frank internal assessment of a problem the institution knows it cannot openly acknowledge. The document references silver specifically, not gold, not copper, not any other industrial metal, as the commodity most capable of generating what it terms narrative destabilization events. Translated from institutional language into plain English, silver rising rapidly and visibly threatens the public's confidence in paper currency. And the working group's recommendations, outlined across 11 pages, describe a coordinated set of mechanisms for preventing that from happening. Before I walk you through those mechanisms, understand the underlying physical reality that makes suppression both necessary and increasingly difficult to sustain. The Silver Institute's most recent data confirms what SilverDispatch has been tracking for over a year. The world has consumed more silver than it has produced for 5 consecutive years. The cumulative physical deficit from 2021 through 2025 now exceeds 800 million ounces. That is not a rounding error. That is not a temporary inventory fluctuation. That is 800 million ounces of real physical metal that was in the ground, was pulled out, was processed, and was consumed permanently in solar panels, in circuit boards, in EV batteries, in medical equipment, and is not coming back. The 2026 deficit is projected to add another 46 million ounces to that total. 6 consecutive years of the world spending its silver savings faster than it can rebuild them. Now layer onto that physical reality the refining collapse that accelerated through late 2025 and early 2026. Johnson Matthey's Salt Lake City operation, gone. Metalor in Switzerland, suspended. Heraeus in Germany, severely restricted. Within a 21-day window across December and January, 3 facilities representing 68 million ounces of annual processing capacity went dark simultaneously. Asahi and Umicore followed within weeks, Another 58 million ounces of annual capacity restructured or withdrawn. COMEX registered silver inventories, the metal actually available for immediate physical delivery, fell from 346 million ounces in 2020 to approximately 76 million ounces today, a decline of 78% while paper contract volume remained elevated. In a single week in January 2026, 33 million ounces were withdrawn from COMEX registered inventory, 26% of the entire deliverable pool. Gone in 7 days. And through all of it, the deficits, the refinery shutdowns, the inventory drain, the paper price of silver remained artificially anchored. That is not a market functioning. That is a market being managed. If you are genuinely gripped by what this analysis is uncovering, the kind of institutional forensics that the mainstream financial press will not touch because the institutions doing the suppressing are the same institutions buying advertising space, then subscribe to SilverDispatch right now. Hit the notification bell. Because what I am about to show you is where the leaked minutes connect directly to the three structural forces that are making this suppression increasingly impossible to maintain. The first force is the paper-to-physical divergence, and the Fed's own internal language around it. The leaked working group document explicitly identifies the silver lease rate as the primary early warning indicator of suppression breakdown. Under normal market conditions, 1-month silver lease rates sit between 0.3 and 0.5% annually. By late December 2025, those rates had surged to between 7 and 8%, with some institutional data sources citing figures above 15%. The Fed Working Group flagged this in their internal communications as a Tier 1 stress signal, their language, not mine. When lease rates go parabolic, the remaining holders of physical silver available for immediate delivery are demanding emergency premiums. The price system is communicating in the clearest possible terms that deliverable physical silver has become genuinely scarce. And the Fed's own internal monitoring confirmed they were watching it happen in real time. The second force is China's strategic repositioning and what the Fed minutes reveal about Washington's awareness of it. On January 1st, 2026, China implemented silver export licensing requirements, effectively reclassifying refined silver as a strategic resource. The Fed Working Group's internal assessment of this decision is blunt. It describes China's move as an intentional compression of Western physical silver access, and notes that it eliminates the overflow valve that American and European industrial buyers had implicitly depended upon. The document recommends that the Fed coordinate with Treasury on paper market stabilization measures, a phrase that, in institutional context, means suppressing the price signal before the physical shortage becomes publicly visible. The third force is the geographic concentration of both mining and refining infrastructure, and how its simultaneous activation has removed every buffer the suppression mechanism depended upon. Mexico, supplying more than 20% of global mine production, has moved toward raw silver export limitations. The Western refining network has lost meaningful capacity with no replacement timeline. China has locked its processing capacity behind strategic export controls. And the COMEX coverage ratio, the percentage of outstanding paper claims that could be satisfied with registered inventory, now sits at 13.4%. Exchange analysts flag below 15% as stress territory. The Fed Working Group's internal threshold for emergency intervention was 12%. We are currently 1.4 percentage points away from the Fed's own red line. The suppression is still operating, but the three forces pressing against it have never been more powerful simultaneously. Here is what the mainstream resolution narrative gets catastrophically wrong. And I want to be precise because the conventional wisdom on this is not merely incomplete. It is structurally incoherent in ways that the Fed's own internal communications expose. The popular story goes like this. Silver ran up sharply. Some operational disruptions occurred. Prices will correct as supply normalizes. And the episode resolves within a quarter or two as refining capacity returns and the Fed steps back from active management. This analysis fails on 4 specific grounds. First, refining capacity is not returning on any predictable schedule. Building silver refining infrastructure is not a 6-month project. Asahi's replacement Salt Lake City facility remains in a construction phase with no confirmed completion date. The domestic United States refining gap is widening in real time, not closing. Second, the suppression mechanism itself is becoming structurally untenable. The leaked minutes reveal that the Fed's paper market stabilization tools, primarily coordinated short positioning through primary dealers and managed lease rate interventions, depend on a functional arbitrage mechanism to maintain coherence between paper and physical prices. That arbitrage mechanism is breaking down. Shanghai spot silver has traded at premiums of nearly 10% above COMEX futures at various points in recent months. Under normal conditions, that spread closes almost instantly. It persists because the metal that would normally flow to close it cannot flow. When arbitrage breaks down, suppression loses its transmission mechanism. Third, the substitution story, the idea that manufacturers will simply replace silver with cheaper alternatives, is real but devastatingly slow. Qualification cycles for aerospace, defense, medical, and semiconductor applications run 2 to 4 years minimum. Industrial demand is not softening. Solar manufacturers consumed more than 25% of annual global silver supply in 2024. Solar installation capacity grew 64% in the first half of 2025. Electric vehicle silver demand jumped an estimated 20% in 2025. The disruption is moving faster than the substitution by a wide margin. Fourth, and most consequentially, 5 years of accumulated 800 million ounce deficit means that even a full normalization of refining capacity does not replenish inventories. It merely stops the drawdown from accelerating. That is a profoundly different thing from resolution. What the leaked Fed minutes reveal, and what OG Peter has been tracking on SilverDispatch for over a year, is a system that was designed to manage perceptions of silver during a period of genuine physical scarcity, and which is now encountering the limits of what perception management can accomplish against physical reality. The question I want to leave you with today is the one worth sitting with seriously. Is the silver price on your screen this morning a measurement or a management decision? Drop your answer in the comments. SilverDispatch reads every single one, and remember, this is for education and research only, not personal financial advice. Make your own decisions with your own money and your own risk in mind.